Broadcast is now starting. All attendees are in listen-only mode.
Hey, thank you everybody for joining us for this is all we typically have our monthly manager focus or monthly manager calls, but we're adding a brand new money manager. We're super excited to have Alpha V added to our lineup of money managers. Super excited to have these guys present to you today. I've got Lee, and he's going to kick it off and hand it over to his partner, Ayal. But I will give the floor to them. But just real quick housekeeping items. I know a lot of people have been on these before, but please, put a message in the chat if you have something. But I'll monitor the questions queue. So please plug in questions in the questions queue. They're going to go through their strategies that they've performed extremely well, and then I will monitor the questions. And without further ado, I'll hand it over to you, Lee.
Thanks so much, Justin, and welcome everyone today. We thought for today to give a little bit of background, since we're new on this platform, give a little background on Alpha V, what we're best known for, why more than 2,000 advisors trust our research, and yeah, let's just jump right into it. So, quick background on Alpha V. Since many of you may not know us, we're over 10 years old. We're in our 12th year. We do a lot of institutional caliber kind of research for firms. We develop a lot of our own signals, and we build our own proprietary data. We're a multinational company with offices in Israel and several throughout the United States. And we've had some ETFs with different firms. Current one, American Century, ticker is QINT. There's some great white papers from the CFA Institute and videos and other things on the RIA channel. Alpha V also offers some of our models in institutional notes. There's a couple of tickers you'll see on the screen, or ISIN codes, if you will, these XSs. And everything that we're going to show you today that's on the Fusion platform usually can be found by tickers, public tickers, and we'll maybe talk more about that. And if anyone has questions, they can, of course, chime in and ask them. So what I always like to cover is when we talk about risk and risk management, and I love this slide, and yeah, I know I need to update it for 2022. But, and maybe you've seen this one before, but I like it. There's always reasons to sell. There's always risk in the market. Risk is ever present. Our skin crawls when people say risk on, risk off. We reject that as a statement of fact. There's always risk. We've always thought it as variable. It's not on off, but it's how much risk, what percentage of risk is there. And you'll see why that statement and why I take the time to talk about it, because we do a variable allocation to treasuries or tips in one of the models we're going to focus on and talk about risk management. So the question really is, how exposed do I want to be to any asset class or to a risk asset class? And we'll talk more about that. But certainly risk management is not something you try and time the market with. Risk managed models like we're going to present are generally 3 to 5 year time horizons. And now let's talk a little bit about risk managed and the family of risk managed products. And as I said, most of these are available on the Fusion platform. If others are desirable, we certainly can put them up, but most of these are available to you today to make allocations as you see fit. So they all share kind of a similar theme. And so once we go through what we call risk lenses, you'll know about all of them. So I'm going to drill down on the top 5 sector equity and treasury bond. And by going through that, you'll understand what the small mid-cap one, how that works, how the ETF one works, etc. So let's continue. So when we talk about risk and risk lenses, we deploy overlays, and these models, I believe all of them rebalance and reconstitute quarterly. Now, what we do in every 90-day period is we first evaluate the market and look at market risk. And as you can see in the slide, when inflation rises, when I talk about the inflation risk lens, when inflation rises, everything is negatively affected to some degree. So we deploy a risk lens when inflation is elevated. We will use part of our allocation model, we'll use TIPS. Otherwise, we'll use IEF in this. Now, when we look at the overall market, though, we first have to ask ourselves a question. If the whole market is dropping, even good stocks are going to drop, and we want to create some kind of allocation means to determine how much IEF or TIPS, as the case may be, should we use in the portfolio. In the top 5 sector strategy, the SMID strategy, the ETF strategy, it can be between 0 and 100%. So there are times, and in fact in 2020, is a time when we were fully in treasuries at one point and fully in equities at another point. So that's what's interesting about our approach. We have several independent overlays, and we're going to get into more of that in a minute and show you how it's worked historically and what the historical research is. Now, in the top 5 sector series, as the name implies, we don't look to invest in the whole market. In fact, what we do is we have our factor models, and we look at factor families, et cetera. And when a sector goes out of favor, we want to not deploy capital towards a sector that's, of course, out of favor. In fact, we want to find the 5 sectors or the half of the market that are most likely to accelerate during the coming period. Then finally, once I know which sectors I'm going to be in, we go through, do our bottom-up build, go through fundamental and technical factors to build a portfolio of approximately 50 names and apply unique selection models for that given sector to pull out the names. So that's a very high-level overview of 4 different risk lenses that can be deployed. Now, let's drill down a little bit farther. When we talk about the 4 risk lenses in the top 5 sector, again, we're going to focus on that, and I'll draw the distinctions between the other strategies in a moment. First, when we look at, again, that market risk, we're going to dynamically adjust our allocation every 90 days between IEF, or if there's elevated inflation like we see currently, we'll use TIPS. And that allocation can be between 0 and 100%, but it's not infinite. There's really a matrix, is the way we think about it and call it. So we look at the overall value of the market. What we're going to do is look at 1,200 companies. And those 1,200 companies, every 2 weeks, we're going to do a temperature check. It's what I call it. That develops a trend line, and we can compare that trend line up or down to the previous reading at the end of last quarter. Based on that trend line, we're going to plot out the quality of the market. Think of earnings to a bunch of stuff, and then value, so price to a bunch of different factors. And it's going to give us these 2 values. Tell us, should we be 90-10, 90% equities, 10% TIPS, or should we be 40% equities and 60% TIPS, for examples. And again, you could be 100-0, 60-40, 80-20, etc. So there's several possibilities in these 9 cells. Once I know how I'm going to be allocated, we evaluate again the inflation factor, check where we're at. If we're greater than 5%, we're going to be using TIPS. Now, we use that to moderate the standard deviation in the portfolio. It's not for income gathering, it's just for moderating the standard deviation, because our risk managed models, what they're designed to do is, on one hand, we're trying to achieve alpha, so give you some CAGR above the benchmark, but we also, the yin and the yang, or the needle we try and thread as we work for you, is to have below benchmark standard deviation. So what we try to do is use the allocation out to TIPS or IEF to lower the overall volatility of the portfolio. And if we can achieve both of those, we feel we've done a very, very good job for this smarter core type of portfolio. And that's generally how most of the users of this model call it, as a smarter core position. Now, then we get into sector risk. We talk about ranking all the sectors. We use the 10 sector classical definition. And we're going to look for the 5 sectors or the half of the market most likely to accelerate. From there, again, for the equity and for the SMID, we'll then go on to selecting 50 names. If you're using our top 5 sector ETF model, we stop here and just buy the iShares, the 5 iShares ETFs. But again, if we're picking names, we're going to look at those sectors. They have to be U.S. equities. If it's the large cap portfolio, it's going to be 5 billion and greater. We'll go through the fundamental factors within those sectors, check liquidity, and finally build our portfolio. So in an example where we're at 2 quarters ago and then this current quarter, you can see how the model will shift. Again, looking at just the markets and the selection models. So we can see here today, we're 90% in equities, 10% in treasuries with these sectors. And current indications as we come into this next quarter will actually shift us more to a much more conservative stance based on all the data that's coming in. So we still have a few days. Things could change, not likely to change in either of our dimensions of looking at the quality or the value of the market, but things certainly could tweak a little bit. So I'm gonna pause right there and turn the screen over to Eyal, and maybe you can show us some of the proprietary work we do inside using our own technology, our data, our signals as we analyze the markets as I described.
Great, thanks, Lee. If someone can give me the screen.
Coming your way right now, sir.
Okay.
Perfect. You should be seeing my screen now. Yep.
Yep.
Good. Okay, so after Lee's given us a good description of what the strategies do, I'd like to show you how we implement them. So we've developed our own software to do portfolio construction. We've built a number of different layers to manage these kind of strategies and manage these 4 risk lenses. And I want to show you how it's actually implemented in the platform, and then we can look a little bit at the performance of the strategies. So looking at the same strategy that Lee was talking about, the top 5 sector equity, this is the matrix that we were looking at, and I just want to recap a little bit. We get 2 scores from our market indicators, a quality score and a value score, and that places us in one of the 9 cells in this matrix. The higher the value and quality scores, the more aggressive we'll be. Then we'll be in the 100 equity and 0 bond. The lower the scores are, we'll be in the lower bottom of the matrix, and we'll be 100% bond. So as Lee said, we'll probably right now we're in 90-10 for the quarter we're closing, and we're not sure yet. There's still another couple of days, but we may shift to something more defensive. So that's the first risk lens, the market risk lens. It determines what of the strategy, what the allocation is to bonds. And the bond piece is used in this strategy to mitigate volatility. So we want to, the way the matrix is built is when the market is volatile and we want to make sure we protect our money, we will move into a more defensive approach where we go to bonds in order to reduce the downturns. The alpha comes from the equity side and the sector side. So that's what we're going to look at now. The inflation risk management. So once we determine that we need to invest in bonds, we make a decision whether we invest in the IEF, 7 to 10 year treasury bond, or TIPS, depending on whether the inflation rate is elevated or not. That's based on the fact that we've seen that lately the IEF has been very correlative to the market. It's not doing what it's expected to do in terms of mitigating volatility and reducing that downturn. So so the next step is, after we've done our market risk and the inflation risk, so now we know what percentage of the portfolio is going into bonds, what percentage is going to equity. We then take that percentage of equity and we determine which of the 5 strong sectors, it's called the top 5 sector equity, based on the same kind of technology that we have for our market indicators. We have sector indicators. So we measure a large number of stocks for each sector. We use what we call fundamental momentum, which is looking at the aggregate score of fundamentals of a large number of stocks over time to see how that scores for every sector. And then we determine which of the 5 strongest sectors, those are the ones we'll be investing in. The weight of each sector is determined by their weight in the benchmark. So we try and keep sector neutral for those 5. So if we're so we take the weights from the benchmark for the 5 sectors we've selected, and then we do the normalization and give each sector the relative weight, and that also determines the number of stocks for each sector. So that's the sector risk. That's our approach to once we've selected equity, we want to be in the strongest sectors. Between and the next level is the selection risk, and that's where we determine which equities for the sectors we've selected, which equities we want to put in the portfolio. And that also uses fundamental data. We have a multi-sector, multi-factor model where every sector has its own valuation model. We select the top stocks based on years of research that we've done. We select the top stocks based on the grading mechanism or valuation model for that sector. So it'd be different from sector to sector, depending on the research we've done and the characteristics of each sector. And then that's where we select our stocks. So that's about 50 stocks plus the Treasury bond ETF. That's what makes up the portfolio. So let's have a quick look at the performance. And you're looking at our software. This is all software that we built to create our own models using historical data for researching into these models. So if we look at the last year, and then we can bring up the portfolio. Oh, sorry, now before we bring up the portfolio, let's look at the performance for the last 3 years, let's say. So you can see here from 2020 onwards, I can switch on the strategies. That'll show you how the market risk has worked over time. So we can see that at the end of 2019, we were still 40-60 and 90-10 in equities. Then at the beginning of 2020, we went to 100% bond. We switched the second quarter to 100% equity and back to 100% bond. I don't know if Lee mentioned this before. That's never happened before, but 2020 was a very special year, I guess. So you can see how the portfolio switches. Sometimes it stays the same for a couple of quarters. So in this case, 60-40, we stayed until we moved to 80-20, and then back to 100% equities. And now we are at 90-10, maybe going into 40-60. So that's how the process works in terms of switching allocation from equity to bond over time based on the market indicators.
Hey, Al, maybe one thing you could maybe just point out, I think it'd probably be helpful. What was the performance of the top 5 sector for the last few years?
So we're looking at the last 3 years. The total percentage return is 71, 72 almost, CAGR of 19, with a standard deviation of 40. So all the numbers are much better than the benchmark. One more thing I'd just like to mention. You can see that even when take this period here. Even when we were partially in treasury bonds, we still kept up with the market. So that's where our alpha comes in. Even though we weren't 100% equity, during this period, the portfolio was a little defensive. It started off at 40 and then moved on to 20. But in terms of the performance, although we were partially in bond, the equity and the sector selection gave us the alpha necessary to maintain market performance.
Yeah. And that again is that overriding goal. We're trying to, as I say, generate alpha, which helps grows everyone's book of business and money. But at the same time, we want to generate active standard deviation. In fact, I'm happy to give up a little performance to have lower than benchmark standard deviation, because I believe low standard deviation keeps the phone from ringing. The alpha keeps the business growing.
So here we're looking at the allocations that we had at the beginning of this quarter, 3 months ago. So we can see we were 10% in IEF, 90% in equities, split up between these 5 sectors. And then we don't know yet how it's going to end, but that's going to change over the next couple of days.
Yep. Okay, why don't we pause there, and maybe, Justin, are there any questions that have come in?
Yeah, we did have a couple questions. You mentioned earlier in the call that you have some public portfolio tickers, and kind of what you're thinking there. Why does Alpha V publish live portfolio data on your SMAs?
That's a good question. Maybe can I share my screen again?
Yes. Bounce it back to you. Here it comes now, Lee.
Okay. And okay, so for that caller's question, so Alpha V here is actually, I happen to have it on the screen. Alpha V takes SMA portfolios. We push them out to the exchange. We have connections, by the way, to Morningstar and major exchanges. It's globally disseminated, calc'd and disseminated, and independently audited. It's all part of our goal to be very, very transparent. We publish in writing our buy side, our sell side discipline. If there's style drift, there should be no surprise that there isn't any when you go with Alpha V. So you can look up a ticker. So we've been talking about the Alpha V top 5 equity and treasury bond portfolio. We push out an index to SIBO, which is the underlying portfolio, but we have to push an index fashion to get on the exchange. And like I said, this is calc'd and disseminated. This one in real time. Other ones are end of day. So this is how it's performed over just today. We can look at it how it's performed, of course, over time. And you can put that ticker in I showed you earlier, the AVT5 EQTB in Bloomberg or Google Finance or Koyafin or whatever the app is that you like using. What we also do is give the kind of overview of the strategy. We'll have links to any methodology documents. So what's our actual methodology in managing the portfolio? And if there's any auditor reports on the performance, these also get linked, and we put that all on a major exchange. We just think it's good business, Justin. At the end of the day, we think all asset managers should just be more open and transparent about how they work and have those kinds of systems and controls in place.
I love it. And then a couple more questions have come in, and there was some pretty good performance there on the screen a minute ago, and Eyal had that zoomed in. Can you kind of show us? I know there's multiple models, but we had two things. Oh, we've got like a bunch of questions coming in now, but kind of the returns on some of the models. 2019, 2020 was a trying year. 2021 was good. Of course, this year it's been a struggle. Do you have the ability to show some of that, or should I give the screen back to?
Yeah, let's give it back to Eyal now.
Okay.
And Eyal, maybe the best thing if you stay with the top 5 sector equity and treasury bond, and just let's do it year by year. if you wouldn't mind, share your screen and
I can do it annually as well.
yeah, let's
So
just
I
year
should
by
share
year.
my screen. The share. There you go. You see it now?
Yes.
Yep.
Okay, so let's switch over to annual and take a look
We
at the
started
left.
2019. Yeah. Let's. Oh no, go to just 2019 forward. I'll going way back. Hey, if people want to see it, they'll ask. But it was specifically 2019.
Okay, well, basically, if you're looking down here at the bottom, you can see the returns on a yearly basis. So from 2010, all green numbers. 2018 was the only year, apart from this year, that we were down. 19, 20, 21, these are all annual numbers.
Okay, so where the cursor is under returns is what you want me to look at. So we can see for 2019, it was 31.5%, 2020, 47, 2021, 25.7. And right now, I can't read it. We're down 16. So we're generating
16,
alpha. Yeah. So we're still generating alpha against our benchmark, the S&P 500. So I hate it's negative alpha or alpha on the negative side of the equation, but it is doing what it's intended to do.
Yeah, those are some great numbers. And when you were talking about standard deviation a minute ago, can you show the standard deviation for the periods as well? You were talking a lot about that, jumped in when you were talking standard deviation. There it is.
Yeah. Yep. So there's your 3-year number. The benchmark was at what, 18.5, and we're at 14.2.
14, 19, yeah.
Okay.
Yeah.
And then
but let's do it. Can we do it by year just real quick for everyone? 2019.
And while he's
Sure.
pulling that up, Lee did send me over the fact sheets on these. I'm sure a lot of this stuff will be really concise and broken down by strategy for everybody, and I can get that at the call-in notes. But sorry, go ahead on the standard deviation again, please.
Yep. So at 2019, if you just jump back for a moment, so our standard deviation was higher, 17 versus 12. CAGR, though, ahead of the market. 2020, again, shows the power of this methodology of having independent risk levers to pull or risk lenses to look at the markets. CAGR, about 47% versus 40,
Yeah.
46.9 versus what, 18 or 19? Again, lower than market standard deviation. 2021, a little bit lower on the CAGR, a little bit lower on the standard deviation as well. Can't do it every year. To have it have both numbers, that's our ultimate goal. We're not perfect, but not too bad either. Nope. And year to date, AL, because of course people want to know this is still very tricky times. Our standard deviation is a little bit higher than the market, and we are generating some alpha. So we're about 3% better than the S&P right now.
Very cool. Okay, yeah, and that was the benchmark of the S&P there, everyone.
Yeah. S&P total return.
One of the callers was when you were referencing, that very transparent ticker. Could you type that in the answers, or I could type it in? They were wanting that ticker, or maybe pull it up on your screen again. Should I give the screen back to you so they could see that ticker and write it down?
Or AL can do it right now.
Okay, perfect. I appreciate that. One specific caller wanted to really.
There it is. So again, it's AV like Alpha V, T5 for top 5, EQ, equity, TB, the treasury bond. So AV, T5, EQ, TB. If you can look it up again on SIBO, just go to like US indices and type in Alpha V and it'll come right up. Where it says find an index. That's how they work. We have to publish as an index for them, like most of the exchanges. You'll see a bunch of the portfolios. These portfolios are all available on Fusion.
Yes, and we'll send that out after we've got the Alpha V. They have a Alpha V Green Transportation, Alpha V Quality Yield, Alpha V Risk Managed Mid, Top 5 Sector, Equities, they've got a mega cap, and then the risk managed fixed income. That's what we currently have in the manager portal. So lots of options there. Wonderful. I think we've got through the questions. Anybody else? We had a couple people who jump on last minute here, but any other questions from the group or anything else you two would like to add?
Maybe the only other thing to let the team know, we do have a manager profile. So if you need a one-pager on us, which has a firm AUA and all the firm-wide stuff, no problem. I assume we have it up on your platform. If we don't, we'll make sure of it.
Another question popped in here, Lee. How are these portfolios as far as ordinary dividends? Looks like.
Well, that kind of depends on which portfolio. So, Eyal, for the top 5 sector, can you give us maybe just yield? What's the yield? Since we talked a lot about the top 5 sector, and that's one of the more popular ones, loads of AUM in it, and it's used in almost all the advisory accounts, SMA and accounts that we have. So yield, I see overall period.
Yield for the whole period is about 2%. If we're looking just year to date, it's just below 1%. Take a look at the last 3 years, 1.5%.
Yeah. So it's not intended to generate a lot of yield. We have a quality yield portfolio. That is it a big deal to switch over to that, Eyal? So someone looking for income should look to the Alpha V quality yield portfolio.
Okay.
It's interesting. The quality yield portfolio. Well, let's take a look at numbers. 6% overall.
6%.
6.1. But maybe what was it the last 3 years? The 3-year number?
More or less the same, I think. It's 5.66 overall.
Yeah. So this is usually fits into advisor portfolios where you have clients that want to maintain principal and hold 5% is generally what I tell people. I know it's yielding more than that. That's kind of a buffer.
Okay.
Now it's made up of just three positions, by the way. So it's built, and even though you're seeing these pretty decent yield numbers, it's made up of U.S. Treasuries, believe it or not, a covered call on the Russell 2500, and preferred shares.
Okay. And that account minimum, Brian asked that specifically. That account minimum for the Alpha V quality yield is only $5,000. So a good portion or a sleeve to get some good yield if you need it there. Then taxable question here. It looks like qualified, non-qualified. So it produces long-term capital gains and taxable accounts would be the.
Yes, it's true. Yeah, we're trading equities. There's some amount of turnover in there, depending on which one. If we're talking to the quality yield, Eyal, what's the overall turnover? You're always invested in all three positions. We just vary monthly the percentages because we're using ETFs, which use in-kind exchanges. The tax impact should be minimal. The actual turnover, which is a proxy, a lot of people like to look at. I can't read it on screen, Eyal. Maybe you can.
It's about 500. It's very high. It switches every month between the weights of the three ETFs.
Okay.
And if you go to the top 5 sector, to also give that same kind of rundown.
Most of the months balance monthly.
No, most are quarterly.
Quarterly.
A month. Yeah, and what the reason why the fixed income one is monthly, and it's again been a good thing, especially during this period. People have gotten too complacent about risk, and the market. So many things are moving so quickly. The monthly rebounds helps because what we look basically is to keep tilting that portfolio each month, depending where the flows are going. So, for example, if treasuries are in favor, we're going to tilt towards treasuries. If convertibles or the covered call is is trending, that's the way we're going to tilt.
Well, that makes
So, and sometimes you have to be more sensitive to the markets than 90 days. And the last 18 months has been pretty much a fact on the fixed income side. The, not the dividend yield, the turnover of the top 5 sector is what, 2 something?
About 250.
About 250 in that.
okay.
And again, yep, there's turnover, absolutely. You look at the CAGR and you decide. You do your portfolio calculations based on performance.
Love it. All right, great. We will send this out to everyone, all of our IARs, with some of the more detailed fact sheets on these strategies. And then if they had some specific questions, is it okay to get them in direct contact with you, Lee, and you take it? What would be the
100%. Yep, just give them my email address, lee@alphav.com, leigh@alphav.com.
okay?
Happy anytime to hear from anyone on the call. If anyone needs custom statistics, you're putting together a special proposal, no problem at all. We'll get you the information. I'll make sure someone gets right back to you at any time.
Okay, wonderful. That's great. Well, with that, it looks like we've got the question queue taken care of. We greatly appreciate everyone on the call's time, and especially the presenters. We will get this call recorded and sent out with fact sheets attached. Probably, maybe not before the 4th of July. If we can't turn it around by Friday, it'll probably be next Tuesday with the holiday coming up. But appreciate it, everybody. Thank you.
Thank you, everyone. Happy 4th.
Thanks. Bye-bye.
Bye.